Hi, this is Alvin from Dr. Wealth. If you have not known by now, the Singapore savings bonds interest rate has hit the 3% mark. And that is quite unusual because we've been living a very low interest rate environment for many years. And now interest rate is climbing to combat inflation. And it is a good thing that you will start to see a lot of this bond interest rate going up, and that includes the Singapore savings bond. So let's look at some of the details and see whether this is a good place for you to park some of your excess cash that you don't need immediately. And this is the latest issue, right? Let me just blow it up so that you can see in more detail. And if you apply by 26th July, and this is the bond that would give you that 3% if you hold over a 10-year period, okay, average 3% per year. So you must be thinking, oh, must I hold for 10 years to get that 3% per year? Or I can sell or redeem the bond earlier, would I still get that amount of interest? So you have to understand that this Singapore savings bond is a step up bond. That means the interest rate will go up year by year. Okay, and average out over the 10 years, you get 3% for this bond. Okay, so how it works, right? You can see the table at the bottom and look at the last row, right? The average return per year. So that is that actual average return that you will get if you hold over that specific time period. So if you hold only 1 year, you'll get 2%. Okay. If you hold over 2 years, your average return over that 2 years, each year you get 2.42%. So you can see the longer you hold the bond, the higher average return you get. Okay, the coupon will also go up. So by the time that you hit the 10-year mark, you'll get an average return of 3% per year in every year in that 10-year period. Okay, so that is how it works, right? So this is something that is good. I would say that even for 1 year, 2% is quite a decent return for a triple A rated investment grade kind of bond. Right? You don't get it. Of course, if you want to compare yields, the riskier bonds will probably give you a lot more. But at the end of the day, is it worth it if you lose your principal? Okay, so SSB is a good instrument, I would say, at this point in time, if you want to park your excess cash, right? So how do you uh, look at this Singapore savings bond? Because bonds, they are known to fluctuate with interest rate. Okay, so one good thing about this Singapore savings bonds is that there is no bond price fluctuation. So which means if you buy $1,000 worth, you will always get back the $1,000 regardless which year you redeem the bond and regardless how the interest rate moves. Because technically, when interest rate is rising, bond price will fall. Right, so they have this inverse relationship, but it doesn't happen for Singapore savings bond. So that's why I think this is safe. Even when interest rate is climbing at this point in time, you will still protect your capital. So that is the very real nature. That is a very unique nature of the Singapore savings bond. So you will not suffer any capital loss. It's almost like a fixed D kind of arrangement, right? But it doesn't have the lock-in period like a fixed D. You can just withdraw it anytime you want. So it offers you the flexibility. It has that capital protection, plus the interest now is more attractive. Right, 3% is even higher than the CPF ordinary account. So some of you thinking of topping up a CPF account, right? This might be a good alternative option, right? To put in the Singapore savings bond at 3% average return over a 10 years period. And unfortunately, of course, if you compare with inflation, which for Singapore at the latest inflation rate is by 5.6%, so 3% average per year, no, it can't really hit. It can't really cover your purchasing power loss in inflation, right? But you don't probably expect the inflation rate to sustain 5.6% or 6% per year over the next 10 years. Okay, so I don't think that's the case, right? But even if that is worst case, right, it happens, your Singapore savings bond is likely to increase the interest rate. So what you can do is that you can sell the existing Singapore savings bond and subscribe to the newer ones, which will have a higher interest rate. But at the same time, you still get back your original capital. So I think, given that the risk is pretty low and with that capital protection feature, it is quite safe to buy this SSB, okay, even at the rising interest rate environment. So if you are really thinking of applying it, how do you do it? You can use your internet banking, or you can use a local bank account, right, ATM, to apply for it. You will need a CDP account. Okay, that's where you store or custodize your SGX listed shares, right? So you will need that. Yeah, it will serve as a custody for your SSB. So minimally, you can apply for $500 up to a maximum of you can only have maximum amount of SSB worth $200,000. Okay, so there is a limit, right? You don't want to let the rich people benefit more than the man on the street, right? Because if you don't set any limit, someone with millions can just dump inside and earn a very steady stream of income from there. So it has some of these limits that's there, right, to protect the man on the street as well. And you can redeem anytime. So let's say you want to redeem, you apply for the redemption this month, you'll get back your capital next month. So it's pretty fast, right? You don't need to everything can be done online. You don't need to visit any branches or what. Okay, so it is quite convenient, and interest is paid for every 6 months. Okay, so that is how it is done, right? So it's pretty straightforward. All right, and I just want to quickly also compare to the fixed D rate that some of you might be interested to explore, because fixed D rate has also gone up, okay, with the rising interest rate, right? And the best rate that I found, okay, so this is a courtesy of a SingSaver. I took the screenshot from their site, and the highest interest is actually from RHB at 2.25%. But you have to put in a fixed D for 2 years at a minimum of $20,000. Okay, so let's compare this with the SSB, right? And 2 years. Okay, so if you hold 2 years in the SSB, right? If you look at the bottom table and the last row, second column, right, you will see the number two there, right? Year of issue date two, and you will get actually an average of 2.42%. That's actually higher than a fixed D. Okay, the fixed D is at 2.25, while the SSB is at 2.42. So even SSB is beating the fixed D. I don't think fixed D is even giving a good deal, right? And we are talking about that's the best fixed D rate you can get out there in the market right now. Right? So this makes me very curious, right? Who actually plays in a fixed deposit? And my friends were saying that they are, because their relatives or elders, they will still do it with the fixed D because they don't understand how SSB work, right? So, but for those of you who are able to understand how SSB work, right, the application wise, you could just do this rather than put a fixed D. Okay, so I guess that's where a little some knowledge on how this works will benefit you. You end up getting higher return, right? Higher interest, lower risk at the same time. Okay, without all the lockdown, without all the lock-in period as well, and definitely it's better than the Singapore bank deposit rates. Haven't really raised yet. Banks, right, as usual, okay, because they would definitely want to raise the loan side before they raise the deposit rates first. So I said 0.12% is not attractive, right? For the first year, you will get 2% from SSB, a lot better in that sense. So in summary, I do think that at 3% is already a very attractive rate. It's above the CPFOA already. In case you are thinking of topping up your CPF, right? This might be a good alternative, right, to lock in a good 3% rate with a investment grade bond, and it's also better than a fixed D out there, right? Hands down. Okay, no matter whether it's a 1 year, 2 year time frame, the interest that you're going to get from this SSB, this particular issue, okay, is better than any fixed D available at the point in time, and definitely better than just parking your savings deposit and just letting it rot there at 0.12%, okay, on average. Of course, different banks may have different perks and different incentives. They may increase the interest rate if you have their credit cards, if the insurance, all this. All right, so if you get a better deal, okay, why not? But I would think that it's still hard to beat the SSB at first year 2%, over a 10-year period 3% per year, right? So that's something for you to consider, right? If you haven't know already, SSB at 3%, take a look and apply. And if you need to, give me a like, give me a thumbs up for this video, right? And as well as subscribe to this channel, so that I will give you more information like this. And in case you don't watch the market, but I do, and you might get advantage of this news and act on it and benefit yourself, right? So this is Alvin. I'll see you around. Goodbye.